for those people who are just joining, and for those people who had probably received an email from our marketing team explaining that tonight's webinar is on and have no idea who I am, I head the research team here at Pepperstone. I've been trading financial markets really since around 1998. I've worked in trading desks in institutional banking in US banks, trading various fixed income products, currencies, the G10 sort of majors there, interest rate markets, and I actively trade FX markets and index markets and some commodities now. The way that I think about the world is I look at liquidity, I look at really what's driving markets from a fundamental perspective and look at how the technicals lay and really go from there. I'm a big believer that a lot of retail traders just can't trade fundamentals correctly. And I mean that with all due respect in the sense that, I talk to clients and they say, we're going to be buying the Aussie dollar because of this. And I actually say, just sorry, Michael, yeah, that is me. I do the occasional... I do the occasional spot on Your Money on Sky Business and Bloomberg and CNBC and those bits and pieces as well. Just a bit of housekeeping as well, just before I go on. If anyone doesn't get my daily note, reach out. I'll be happy to put you on that, and we sort of talk a little bit about what's going on. There will be a recording of this as well, but if anyone wants the slides, if you're a client, then we'll send them to you as a matter of course. If you are, you're not a trader with Pepperstone, feel free to open up a demo account or reach out, and we'll send you the slides as well. So there shouldn't be an issue at all. We're going to cover a lot of ground today, and some of it's going to be fairly complex. But I genuinely believe that the factors which I'm telling you today are what's moving the markets. And it's, you go on Sky Business and you hear people saying, oh, the market's down because of Brexit. Well, that's just simply not true. And I'll try and find out exactly what the problem is and look at, overlaps of charts, correlations to find out what genuinely is moving markets the Aussie dollar, for example, is it moving because of what's happening in China? Is it domestic factors? Is it terms of trade? What is it that markets are sensitive to? Then we can actually really understand what the fundamentals are driving. So, I've seen a lot of people saying, I'm going to buy the Aussie dollar because, the RBA are going to do this, that, and the other. And I say, well, actually, have you seen the rates pricing? Do you understand what's priced in? And do you understand where the communication is going? And they're like, oh, we haven't really looked at that. And I say, well, actually, that's all generally factored in. Oh, we're going to buy the Aussie dollar because iron ore is going up. Well, I say, well, actually, do you know what? Aussie dollar actually has a negative correlation with iron ore at the moment. So, for me, unless you actually genuinely know what you're doing with fundamentals and you actually understand what is driving something, the sensitivity, the variability, if you can understand regression analysis and all the various factors, fundamentals for a lot of retail traders is very, very difficult. So my first point of call for people who are learning their trade in markets is price is true. Price reflects everything that's known at any one given time. So understand price action analysis. Go and get a really good education around price action, and technical analysis. If you can have the two of those, you're really incorporating everything you need to understand about risk analysis, risk reward, probabilities, which is ultimately what we're doing. The markets are a set of random variables, and our job is to manage the risk in the portfolio. Obviously, we want to grow the capital in the account, but ultimately our job as traders is to manage risk and understand the probabilities in trading. And I think unless you can actually understand the fundamentals, what correctly is driving markets, then I think in most cases avoid that situation. Now, obviously, if you're making money off fundamentals, don't listen to a word I've just said. Your objective is to create an edge, and whatever that may be, and how you go about doing that is up to you. But in my case, the majority of retail traders will do much better at their system if they can create an edge through technical analysis and price action analysis, and obviously understand the risk and things like implied volatilities. So that's really what I want to look at today, and I want to look at ultimately where the consensus is for 2019, and the other what people are saying about where markets are going to go. And I think the first thing you can take about that is actually don't listen to an absolute word of it, because I think if anyone tells you where the Australian dollar is going to go by year end, it really matters absolutely none for you guys as traders, because all it does is it creates a bias. You trade price moves, price reacts, things change, and without that situation, you need to be able to react. And me coming in and telling you where the Australian dollar is going to be at year end, or Goldman Sachs or PIMCO, buy side funds, whoever it's going to be, it means absolutely nothing whatsoever if you're trading market, you're trading price. So I'm going to tell you where things are likely to go. And I think the interesting concept for me is not so much where they think things are going, but the actual thought process behind it, and that's where I'm going today. So don't necessarily take on board what I think is going to happen with these markets. I think to me it's more about the thought process behind how it goes from A to B, and the quality of the journey that it gets there. So I think that's really the main issue. So yeah, we'll cover a little bit about the fundamentals, what I think is really, really important to markets. Some of you guys are going to thoroughly disagree with me, and that's absolutely fine. Happy to have some banter and bits and pieces afterwards, or perhaps even while we're going along. I'll sort of chuck any questions to me if you want to. I'm happy to go through that. But Paul, in terms of what are your thoughts on yen repatriation leading into March 31st? That's probably a tester for me straight off the bat. Is that their tax year end, or I'm not sure the relevance of March 31st. Yeah, it's the tax year end. Yeah, to be honest, I haven't really considered it too much at the moment, to be honest. So I'm looking at the yen for other factors, which I'll cover more at the moment. And right now, the sensitivity to dollar yen and is very much around US rates, which I'll cover in that situation. So maybe that's something that I can look at more about the seasonality of how dollar yen and the yen crosses trade are going into that yen. First thing I've been looking at is how it trades going into the tax repatriation. So yeah, certainly looking at the seasonal side of things there. Quick one: can a retail trader achieve this idea about not being able to trade fundamentals without access to experienced subscriptions such as Bloomberg and Reuters? Now, it's a fantastic question. Yes, by asking me. No, I guess the answer is probably in most cases it's very difficult to do so. There's access to analysts. I mean, most brokers now have analysts you can have very readily access to. I put out a note every day, which people are more likely to come back to me with questions and various bits and pieces, and things like TradingView and these kind of capacities will allow you to overlap certain chances, but they're certainly quite limited to some of the stuff that I can do. So yeah, it's very difficult, and then that's why it sort of feeds into my answer that trading real fundamentals and looking at the real factors is quite hard to do at the moment. But Twitter as well is another fantastic tool, and find out really good people to follow, and they can give you a lot of wealth of knowledge as well. Now this is going to go on for a while. I apologise, it probably might go on for a little bit longer than I expected. So I sort of like to talk and hear the sound of my own voice. So if it goes on a little bit long, feel free to listen to the recording. I'm sure it's the time of day where a lot of people want to have dinner. But the first things I want to cover in the first part is really the oversight of what I think is going to happen for the year. Now, what we saw in 2018 was clearly a year of higher volatility, certainly as we came into October and December. If you have a look at the left-hand chart here, you can have a look at the black dotted line there, which is the VIX, which for those people who are not quite sure what the VIX is, effectively it is the implied volatility of the S&P over the coming 30 days. And, if you get a level... with implied volatility, I recently did a webinar on implied volatility, and I think it's such a useful tool for traders, especially in their risk management, to understand potential or the market's expecting about a specific move. Specifically in currency markets, I use it all the time to understand what the market's pricing in for potential moves for the week. But the VIX here, the volatility of the S&P. You can see here on the left-hand side, it's got a bit of a lag, 24-month lag, but you can see here that the yield curve, when there's moves in the yield curve, that ultimately leads to a situation in higher volatility. And that's been one of the stories, what we've been seeing in 2018, is we saw this rampant flattening of the yield curve. And specifically, I've looked at 3-month versus 10-year US Treasuries. So real short-term rates moved up much more aggressively than longer-term rates as people priced in aggressive Fed funds tightening. And when we saw that bear steepening coming through, and that's ultimately led to a situation where this curve flattening has led to the idea that perhaps rates are going up too fast, and that's where we kind of are now, in a situation where people are trying to understand what the Fed are going to do with interest rates over the next sort of 24 months. and we've come to this sort of herd mentality where pretty much everyone on the Federal Reserve have outlaid a patient stance, and patience really is the word for 2019. But what we can see here is this big pickup in volatility really was centered in credit and also equity markets. And a lot of that was down to the impact that we saw from the yield curve. So what I'm looking at this year again is continue to be whether we're going to see extended and elevated volatility in equity markets. And what we can see there is the best predictor of volatility in the equity markets has been the US yield curve. Again, I'm very happy to sort of go into more detail in other webinars, or if people want to reach out to me, chris.weston@pepperstone.com, I'll be more happy to sort of go over sort of more fixed income ideas. But the idea here is when you do see a flattening of the yield curve, you end up seeing you end up seeing, because this red line is actually inverted, so when it's going up it means that the yield curve is flattening. So when you see that yield curve flattening, again you can see that with a lag you get implied volatility in the equity market kicking up. So if people are out there who are trading the S&P 500 or the Dow or DAX or whatever the market is, the ASX 200 SPY futures, the best predictor of future volatility, as you can see from this chart, which I think is the idea that you are seeing a flattening of the curve. So basically outperformance from long end yields, and that ultimately reverberates into a situation where we get higher implied volatility. There's a lot of charts here which I've got from third parties and I've sourced them. So as I say, that if you want these slides, predominantly it's best to be a client, but if you want to reach out to me, as I say, Charles, chris.weston@pepperstone.com, and I'll be happy to try and answer any questions I have around those. So you've got the VIX there. With the VIX effectively, Doug, is leading the market there. So what you end up seeing is the yield curve is leading the market. So what you end up seeing is a flattening of the yield curve will move the VIX. So what they've done is they've pushed the VIX back into that situation there. What I want to have a look on the right-hand chart, though, is the VIX, again, the S&P volatility, which is the green line there, where you can see just what I'm talking about there with the kind of random, or not random, the kind of violent spikes up there, where people were buying volatility structures quite aggressively, and you can see these big pickups throughout the last, since 2009, really since the GFC. But through 2018, we saw these two big rapid spikes up in implied volatility, and no doubt that a lot of people would have been trading that sort of move between October and December. But if you look at the red line, what I've done here is I've looked at implied volatility in FX markets, and I know there's going to be a lot of people in this in the audience today who are FX traders. Most of our client flow is predominantly trading around G10 FX markets. And a lot of people have shown a lot of frustrations about the lack of volatility, the lack of intraday range that you see. I look specifically at implied volatility, but our clients look at more on the realized volatility, and you can see realized volatility through the average true range. If I bring up my MT5 chart here, you can actually see euro dollar where it is at the moment. Now I've got a 10-day average true range, and we can actually 3 points. So the average range, or the true range over a 10-day period, well, I can go back further, but you can see that historic volatility relative to the mean, where these different variables have been relative to the mean, which we use as the 20-day simple moving average. You can see there we're trading sort of about 63 points, and again, that's just shows that the volatility in FX markets is shot to pieces at the moment. What's going to see a pickup in? And that's a question, that we field all the time. Is there's so much volatility. There has been so much volatility in credit markets, high yield credit markets, and also equity markets. Are we going to see that playing through in FX markets and see bigger ranges? And that's the story that I'm asking for 2019. Effectively, I think what we're going to be seeing, what we're seeing at the moment in FX markets, is all central banks pretty much doing the same thing, and that has been that everyone sort of herded into this kind of this idea about what's going to happen with global growth. We are now seeing signs of a slowdown in most economies, and therefore central banks have really been herded into this sort of conversed sort of not defensive stance. I don't think we've got to that point at the moment where everyone's really defensive in their view, but certain banks, such as take the Fed for example, or arguably the most important central bank out there, they've looked at their balance sheet. We'll talk about that in a minute. Obviously, they've come to a concerted view that rates are on hold for a foreseeable future. The ECB acknowledging downside risk. The RBA will probably open the door to easing at some stage. And what we've got is a situation where you've got there's no real division between central bank policy at the moment. What we want to see to create big volatility in FX markets is central bank divergence. That's the trade we're looking at for 2019. If the ECB were ever to turn uber dovish and open the idea of more stimulus, or the Federal Reserve was subsequently starting to go, the world's actually not too bad, and signal that they're back on for 3 rate hikes this year. You've got rampant central bank divergence in that situation. Euro vols will pick up significantly, but the point being is if you look at the stance of different central banks, you've got to look at the moment they're all sort of doing the same thing, and that's suppressing volatility. But this chart I think is really important because what we're seeing at the moment is fairly suppressed vol in FX market, which is really it's a bit more tough for FX traders. And I think in that situation, of course, when you are seeing average true range falling, implied volatility falling, you can effectively run the risk of putting a stop loss close to the market, which means increasing position size accordingly in that situation. Whereas, of course, higher volatility, implied volatility, you're going to be taking, you're going to be putting your stop loss further away because the chance has stopped out. Therefore, you have to adjust your position size accordingly. But at the moment, what's going to create higher volatility is the question that I'm asking for 2019 FX markets, and it is central bank divergence. You want to be seeing, be it the PBOC, the RBA, the RBNZ, having clear policy divergence from other key central banks, and currency markets will move because you're going to see big divergence in bond markets as well. So, that to me is a really key question. Now look at the chain of events, which I think this is really sort of educates my school of thinking about markets and the hierarchy effectively of how this all works. And the first thing for me is liquidity. Liquidity is the oxygen of markets. It's the lifeblood of markets. Take liquidity away, and you see a situation like we saw in October to December. You can see the S&P here on the green line, and what I'm trying to do here is display how markets effectively bullied the Federal Reserve to change their policy. So I'm seeing people coming up to me and saying, the central bank controls the markets. Well, yeah, to a point. I think if people actually say, well, the central bank can do this in the future, markets will trade around that. But ultimately, when the markets want something, they will get their way. There's no doubt about what we've just seen through October through to December will come down as a case study in how markets interact with central banks and how central banks have to surrender to markets because financial conditions change so radically that central bankers are so worried about what the impact of market conditions can do to broader economics. And markets were displayed and pushed because of liquidity. So liquidity and the measures around liquidity for me are the hierarchy. They're right at the food chain. They're the human being. They're the lion. The food chain. Financial markets react and they can create and change economic data. And of course, economic data can change a central bank response. So for me, they're the chain of events. How do I think about markets? Well, you've got to understand liquidity. And I'm going to be focused very much on liquidity and where liquidity is at the market. But if you have a look at this case study, I want to have a look at this. This is really important. We're going to be talking about this, I think, for some time. We talked about how Jerome Powell, who's head of the Federal Reserve, when is the next FOMC meeting? I will have to get back to you on that one. Drop me an email and I'll let you know. But I think what the issue is that you have a Federal Reserve chairman now who is making communication mistakes left, right and centre, and that's increasing volatility. So you go back to October and Jerome Powell said that the central bank were a long way from neutral. So neutral, the policy setting is effectively where the central banks see the Fed funds rate being in the future relative to their estimates on inflation and unemployment. And where those views are is that policy setting for the Fed funds rate, their interest rate, which is neither restrictive or accommodative, is the neutral setting. So, when he came out and said at that time that they were a long way from neutral, the market said, oh, these guys have got a long way to, a long way to put up interest rates. Now look what happened in that situation. The S&P, the green line here, started coming down pretty sharply. Now that created a tightening of financial conditions. We can see that in that situation where the equity markets came down, even though they were signaling rate hikes were very much on the table. The risk sentiment that came out the market saw dollar yen, which is this purple line, moving down as well. So it really started from this date here, and we saw that the dollar yen came down as well, and it had a reasonably strong correlation. What we then saw with a bit of a lag was this interest rate settings. And for interest rate markets, again, this is something that is very difficult to get for a lot of retail traders, is the differential priced in between in the euro dollar futures, which is a tradable interest rate market, the yield differential between the March 2020 contract and the March 2019 contract. And if you can get that yield differential implied by those two contracts, you can effectively see what is priced in between March 2019 and March 2020. And what we actually saw was a situation where up here, we're pricing, if we go down to the right-hand side, about 40 basis points of tightening at that stage. And as the equity market and dollar yen fell, rates came down to about 30 basis points, so just over one hike in that situation. We saw a market sort of tumbling around, and then we came into a situation where the Fed chair, Jerome Powell, came out and said, actually, no, I made a bit of a mistake. Actually, where the Fed funds is actually, actually just below the bottom end of the range of the neutral estimates. So he came out and said, well, actually, no, the Fed, all the various voting members have their own view about where the neutral rate is set, and effectively, we're at the bottom range. Where the market said, oh, well, we know that, but he's trying to undo some of the bad work. And we had a bit of a rally on the back of that situation. As we got into the Fed meeting, you can see a situation where markets continue to fall. They said that the balance sheet was an autopilot. The market at that time was seeing some real clear economic fragility coming through in China, Europe, and also in the US. Certainly we've been seeing that in the interest rate sensitive parts. And the fact that they continue to see 3 rate hikes despite this economic fragility. And effectively, he said that the balance sheet was an autopilot. Saw the situation where the market got a bit worried about that situation, and we saw that the S&P really falling pretty hard, dollar yen coming out, and rate hikes really got priced out to the point we actually saw in that period where we can come back here, we saw 40 basis points of tights, which effectively is nearly 2 rate hikes, just under 2 rate hikes. And you can see with all this risk-off sentiment coming through, that rate hike expectations got down to around about negative 30 basis points. So at this time, we were pricing in over 1 rate cut. So the market's effectively saying, no, you guys have got this wrong. There's a policy mistake that's been made. You are going to have to change your outlook. But you can see here that the S&P is leading rate markets all the time. The S&P is leading the way that the Fed communicate. At this time, after this big drawdown in asset prices, Jerome Powell actually came out and said, no, you know what, we've got flexibility around the balance sheet. We don't have to continue tightening and normalizing the balance sheet at the pace we're going. And the market's effectively won. You can see the big turnaround in risk sentiment coming through here. And Jerome Powell surrendered to the market. So if we have a look at this situation, liquidity, which I'll touch on in a moment, came out the market. The market obviously very concerned about the communication from the Federal Reserve. And effectively at this time we've been seeing worsening economic data, and there was a central bank response. But you can see here the S&P seems to be leading the charge and leading effectively interest rate pricing. But again, just to reiterate, when the markets want something and they act as one body, whether it's algos, whether it's different funds, when they want something, they can be a very powerful force, and we can actually see the central bank reiterating that. Okay, so what to me is the big liquidity exercises for the market? Well, first of all, quantitative tightening. There's no doubt that if you have a look at the various central banks who have been using monetary policy in very unconventional manners, and that's maybe something that we may see from the RBA longer term. But at the moment, it's really been the ECB, the Federal Reserve, the Bank of Japan, the Bank of England, and the Riksbank who have been using their balance sheet to increase liquidity into markets. A lot of that obviously going into risk assets through quantitative easing. And now we've been in a situation where you can see really since the back end of sort of 2017 into 2017 that the balance sheets of the aggregated economies has actually been contracting. They've tried policy normalization. And you can see that as these balance sheets contracted, and I think this is a really important chart, a lot of the liquidity has come out to markets, and they've really struggled. A lot of the time when you print a lot of this assets, when you print this, it creates excess reserves. And of course, in that situation, those excess reserves effectively go into credit markets. People want yield. They go into equity markets. And it's been a very, very positive exercise for people who have been invested to understand how balance sheet expansion and contraction has influenced the market. We can see that here by the Fed's balance sheet expansion, really since 2009, as they printed money, effectively going out and buying US Treasuries and mortgage-backed securities from investment banks, increasing that liquidity. And you can see that as the Fed's balance sheet increased over time through quantitative 1, quantitative 2, and QE3 through these periods, it has marked periods where we saw new periods of quantitative easing, and again, a lot of that liquidity goes into the equity market. You can see here that this is the moment that the Federal Reserve stopped effectively buying assets. So what is quantitative tightening? Quantitative tightening, I've got a couple of questions around that. Quantitative easing was the idea of the central banks printing money with the idea that they could use that capital to go and buy bonds from banks in the secondary market. You end up seeing a big significant increase in base money, and effectively a lot of that liquidity, that excess liquidity, as I say, which had made its way into risk assets. And so central banks used that balance sheet expansion to try and use asset markets to try and reflate economies. And we can see here the quantitative easing with the easing of monetary policy settings fed into the S&P, and you can actually see now as quantitative tightening happened, as effectively what's happening now is that the Federal Reserve and other central banks who hold all these US Treasuries and mortgage-backed securities on their balance sheet, at some stage they will vest, they will mature, and the central bank is forced with an idea. Do we take the proceeds and give that funds back to the US Treasury Department, which is kind of what we're seeing now with the Federal Reserve, or do we reinvest those proceeds and keep the balance sheet at contraction at a constant level? And effectively now what we're seeing is these maturing proceeds, the bonds and mortgage-backed securities held on the Fed's balance sheet are allowed to run off, and that balance sheet is falling, and therefore what you end up seeing is a lot of the liquidity is coming out of markets. So what we're seeing there, as you can see, is the bonds and the different assets which have matured have come to a stage where the central banks are saying, do we get the proceeds from these maturing debt instruments and do we reinvest them and keep the liquidity abundant, or do we take that out of the market and give it back to our Treasury Department? Now, as you can see here, that the central bank balance sheet is contracting, and that's taking a lot of reserves and liquidity out of markets. And there's no doubt, as you can see here, the forecast, this one from Citigroup, is that we're going to see this continued quantitative tightening going forward. So you've got to think about a world where that's happening. The other one is the global M1, and you can see the correlation here between falls in the M1 money supply, so cash and deposits that are out there, effectively again another liquidity measure. And you can see here that the falls that we're seeing at the moment in the global M1 money supply, and this one's from Nordea Bank, you can see that their forecast is this continues to go down. Now look at the correlation that we've got and the influence that we're seeing here with the S&P. Now I've used, a lot of the time I will use the S&P. It is the world's institutional equity benchmark. Is printing US dollars in QE disinflationary? No, it's not, because you end up seeing a situation where a lot of assets that are priced in dollars will go up as a result of printing US dollars. And that means commodities, and that will be inflationary by its very nature, Paul. So if you've got an asset that's priced in US dollars and the US dollar's falling because of the expansion of base money, you end up seeing a situation where a lot of assets are going up, like oil and gold and copper and whatnot. And effectively you see a situation where people are taking more risk in markets, and assets generally go up. People's houses tend to go up because a lot of funds go into that market as well. But you can see here, going back to this situation, that we are seeing the M1 money supply has been falling, and that's been having a big influence there. So when I talk about liquidity being the overall influencer of markets, the idea that the Fed's balance sheet and central banks' balance sheets are contracting is taking liquidity out of the market. You can see the influence it had on the way up. You can see potentially the influence it has on the way down. And you can also see money supply, as money supply is falling. Again, that's having an influence on the S&P as well. The other thing I look at is fund flow. Now, unfortunately, the data that I've got here is a monthly data, and so we're still waiting to see what happens in January. And this is the data we got from Bloomberg. There's actually nothing from Citi here, but what I look at is how the liquidity from central banks, which has been coming out, the fall in money supply is influencing fund flow. And what we can look at is ETF fund flows. We can have a look at mutual fund flows. How different players out there, CTAs who are effectively trend followers and trade futures, different asset classes. But specifically, I want to see this big tick down in December in US equity mutual funds. So you can see here, $86 billion coming out of equity funds. So again, when we're talking about liquidity, it's not just about what central banks are doing and taking out X reserves from markets. We're also seeing a situation where equity capital is being suctioned out, vacuumed out of markets, and that's causing lower volumes and where you're seeing less participation in markets. Basically what you see is order book dynamics taking place, and you see a situation where the bid dries up, and anyone who wants to go and short sell a market, there's very few people on the bid or who are buying, and it's very easy to push markets lower. So what we look at is the fund flow data, where we can see this rampant exodus of equity funds. And if you're an algo who's sitting there identifying order book dynamics, how heavily traded is the bid, how much is on the offer, you're going to be able to push markets down very, very easily in a situation where you've got exodus coming of capital. So we look at fund flow data here, and you can see through November there was a big tick down, and in December probably the biggest one we've ever seen coming out of markets. In January, I'd imagine they probably picked up a little bit there, but what we do is we're looking for constant fund flow data. You can see going into money market funds, these are very defensive assets. Again, so this is where the money's flowing out of equity funds in December into money market funds. I think when we look back at this in December, when this fully ticks, there's going to be a nice bid coming back in as a bit of money's coming back in. But again, the idea that you're getting this big capital withdrawal coming through markets, again, really leads to the idea that it's really easy to push markets down when capital's flowing. In this one here on the right hand side, we're looking at Japanese funds. So this is something that we can get every week. The Ministry of Finance in Japan give us a clear idea about what Japanese pension funds are doing. These guys have absolutely billions and billions and billions of dollars at their disposal. And again, you can see this against the S&P. So what we're trying to do is have a look at what Japanese funds are doing for overseas assets, and this is on a weekly basis, so it's a bit more sort of real time than what we see on the sort of mutual fund data flow. But what we can see here is that there has been a sort of a trend from Japanese funds to look to sell out of US assets. Now I think that's going to start reversing, and what you can see through this period here, through April through to October, is this is sort of obviously a consistent theme where Japanese funds were looking to buy overseas assets. So this obviously looks at what Japanese funds are doing with overseas markets. And you can see the trend has really been from December to January to look to sell out of US assets as well. And I think that's going to be a trend we're going to be seeing throughout this year is big pension funds across the world looking at trades outside of the US. And I'll go into that in a minute. But again, looking at where the capital is flowing, and it feeds into the idea of what liquidity is doing. So these are it's very difficult to do as a retail trader to understand, to get this data. And that's the sort of thing that, that a lot of professional traders, unfortunately, can have a bit of advantage again. Again, this feeds through into price. So you'd be able to see it in price quite clearly yourself. Okay, so I've talked a little about liquidity and how it influences markets. If there's less liquidity, if liquidity is coming out of markets, there's big headwinds. We talk about where capital flows are going. Again, if there's big exoduses markets, that influences things as well. And that to me is a consistent theme that the Fed know and central banks know is what happens with the balance sheet is absolutely critical, because it leads into the perception of what's going to happen with liquidity. So what is the central thesis for me? And what's my sort of central macro thesis for what I think central banks are going to do to sort of counteract this and make sure that the asset prices, don't get hit too badly? Well, the first one for me is that we know, and we saw that from the sort of case study about what's been happening through October to December, that rate hike expectations are really following equity markets at the moment. So if we continue to see this short-term uptrend that we've been seeing in the S&P, if I bring up my my S&P chart, obviously you've seen this nice move up. I've got a 4-hour chart here on the S&P. You can see it's just trading up in this kind of wedge pattern at the moment. Actually, just on a sort of a side trade, 15% increase in the S&P since really Jerome Powell signaled that he was having much more flexibility around the balance sheet. So we go back to this argument that the market's obviously worried about what's happening with the Fed's balance sheet and the liquidity drain that comes from that. But as soon as we get saying that we're flexible about the balance sheet, which means they may stop the maturing proceeds from running off and actually continue to reinvest, so their balance sheet is maintained at this current level. The market said, "Oh, that's fantastic. We're not going to get this big liquidity drain through markets." And you've seen this big rebound. There's other factors at play as well, like earnings and whatnot, but and higher oil prices as well. But you can see this that the market now is just trading in this wedge pattern. We've got price just really testing this trend support levels at the moment. Actually, I think as a trade, if you do get a break of this wedge pattern, then you'd probably be looking for around 2480 would be your technical. Momentum has changed now, so I think this is a bit of a make or break session. This isn't really a looking ahead for the year, but I think as a short-term trade on the 4-hour S&P chart at the moment, or US 500, if price can find some buyers off this level, I think we're probably going to go higher, and you'd be looking sort of back above 2700. But if you do see price giving way through this sort of confluence of support levels, then I would be looking for sort of 2480. And of course, if you're going to see a lower S&P, that will reverberate into other markets as well, and I think there's a high probability that that's going to happen. So that's certainly something that's on my watch list at the moment. But you can see a nice move up that's been happening in the S&P there. So what am I looking for there? The focus is really all about the balance sheet. So when we go to this Fed meeting, the next one that's coming through, which I can't remember the exact date, then actually, if I hold on, I'll be able to tell you the exact date. Bear with me 2 seconds. I'm going to have a look on my... Okay, so the next one is on the 31st of January at 6 o'clock in the morning. There you go. There's the next FOMC meeting. So when the next one you want to have a look at on the 31st is we know that they've already told us that they're going to be on an extended pause. So it's not really an issue now. The markets have priced out rate hikes and they're pricing an element of cuts now. But the focus for me is the idea about what's happening with the balance sheet. The idea about, if the balance sheet stays where it is at the moment, we're not going to see further liquidity drains from markets. If the balance sheet is going to continue normalizing and they're going to allow the assets to mature and run off, that balance sheet will fall, the excess liquidity in markets will fall. And so that's the bigger issue for me is when Jerome Powell steps up at 6:30 to talk about what's going to happen, we're already focused on what's happening with the balance sheet. The algos, the news recognizing algos who react to pretty much every word, every nuance, every sort of sentiment tone, will be focused completely on any news around what's happening with the balance sheet. So the ECB, well, the ECB are, to me, going to be a bit more of a price taker for 2019. And I think, they're going to be very, very sensitive to the euro. So I think the euro, to me, is the new central bank there. So I think moves in the euro effectively will set policy expectations. So we are going into May, and we're going to see the European political situation come alive again. There's going to be European elections playing through. So I think politics again will continue to be a thematic in Europe. We get a new ECB president coming through on the 31st of October. So Mario Draghi, who has been arguably for me the volatility suppressor of everything in European markets. Every time he steps up to the mic to talk, you genuinely see it being a euro negative and an equity positive. You'd see good buying coming through in the German bond market, and he likes to see implied volatility lower. That changes under a new ECB president. There's a whole range of people that could be, but I think the market's expecting a fairly clear transition into a new president who is going to be setting the scene as someone very similar to Mario Draghi's view, and that is, of course, very accommodative. But if we do get a bit more of a German influence, we can see higher volatility in European assets. The other thing to consider is we will get a new, fresh, long-term refinancing operation. So for people out there who are new to what a TLTRO is, effectively throughout the European debt crisis and onwards, the ECB effectively gave European banks access to very, very cheap liquidity indeed, almost free money for these guys. So they could apply for as much money as, well, with limits. They could apply for a significant amount of euro capital from the ECB to really address their funding issues, and also, you know, the idea at the time was really to try and prop up the European economy by saying that you can have very, very cheap liquidity. The best return you can get for your shareholders is to go out and actually lend using those liquidity, so you can actually get a better return. And that was, but a lot of them ended up, some of that money went into the equity markets, some of it went into the bond markets, credit markets, but the capitalization of the banks went up, and of course the banks did very well in that situation. So I think in the next few months we are going to be hearing from the ECB about a new targeted long-term refinancing operation, where the ECB's balance sheet will probably ramp up again, and the banks will be given access to a whole chunk of very, very, very cheap money, which they can do whatever they want. So that, to me, is a bit of a euro negative, and we can look at times before where the balance sheet has been expanded for the ECB and the influence that's had on the euro. I can't do it now because I don't have access to that situation, but you know, I think that would be a euro negative. So what we're looking out for as you know, as macro strategists, is the idea about what happens with a fresh round of what we call targeted long-term refinancing operations. So the ECB will be actually meeting this week, and if there's any sort of clear clues around what's happening there, then I think that's going to be, you know, that's going to influence the euro. The Bank of England, well, the Bank of England doesn't really matter at the moment. What you've got of the pound, for people who've been trading the pound, if you haven't been understanding what's been happening with Brexit, then you've been in the cave, or just probably done the right thing and just toned completely off. But the issue with the Bank of England is they have an itchy trigger finger. They want to raise rates. Every central bank wants to be in a position where they're raising rates. You know, there's no doubt that they absolutely want to be raising rates, probably the end of Q1 into Q2, but they can't do it. They're in a position where they're just beholden to what's happening in Brexit. So, you know, I think if we do get a positive resolution to Brexit, which at the moment, if anyone can actually tell me this is going to end, when pretty much every sort of avenue seems to be poo-pooed at the moment, then, you know, you can have my job any day of the week, because it's just a very, very uncertain time. I think we will see a positive resolution, and I really want to buy the pound. I think the pound could be arguably the best performing currency of 2019, because there's so much hedging that's still very much involved in the pound. People have protected their downside risks, and it, you know, it could go anyway. But I think the market has told us, if you bring up a chart of cable, which I'll do now. Where are we? Okay, so if we have a look at a chart of cable, that you can see this move up from around 124.20, or maybe a bit higher. You know, it's been sort of trading in this this bullish channel. We sort of tested the September downtrend. We've had a bit of a crossover in stochastic momentum, but this move up here has really been premised on the idea that of a no Brexit, a hard Brexit, has been priced out. There's been so much political will from 85% of MPs that they want to avoid this, and if that means extending Article 50, should it be allowed, then you know, you've seen the market repricing. A lot of these bearish exposures here have been unwound. A lot of the hedging has come out of the market, and I think the market's putting about a 15% probability that that we're going to see a worst case scenario, which is a no deal Brexit being agreed by, or no deal being agreed by the 31st of March. So yeah, for me at the moment, trading the pound is very difficult because it is a political currency. When a currency is considered a political currency, you know, you are fighting headlines, and headlines will move much. Algos will react far quicker than you or I. Australia, well, what we're watching at the moment is the feedback loop between falling asset prices, obviously house prices, and equity markets into the real economy, and we're seeing signs of that now, and that's really what I want to see. I mean, the Aussie dollar could get absolutely smashed this year if the RBA acknowledged, open the door, not just for rate hikes, but go along with what Christopher Kent said late last year, and that is that they're not adverse to using their balance sheet and leaning on their balance sheet should the situation arise. Now, I think we're miles away from that situation. Don't get me wrong. You know, I'm not the biggest housing bear out there in the world, but I do see people changing their behaviour. I think there's going to be less auctions in the sort of 10k radius of Sydney and Melbourne. I think people will revert back to sort of private sales, and I think you're going to see house prices stabilise at some stage. But we are seeing signs now that there is a feedback loop between the real economy. We saw that with Westpac consumer confidence dropping the most since 2015 the other day. We've got NAB business confidence next week. You're going to see that coming out. That's trending lower. And again, the RBA is concerned that the fall in asset prices will start hitting, things like retail spending, consumer confidence. You're going to see savings rates going up. And I think at that point, the RBA's rhetoric will have to change. And that's something I'm going to talk about in a minute. China, well, I think we're going to see a slightly stronger CNY. I'm really looking at M2 money supply as the big driver there. Bank of Japan, not much that the Bank of Japan can do. They continue to change the liquidity dynamics. But for me, I think looking at their balance of payment, I think is an interesting one there. You're seeing their basic balance is deteriorating. The combination, therefore, of the trade account that has been falling into deficit. You've seen an increase in foreign direct deficit, and that's deteriorating the basic balance effectively. So, I think a falling balance of payment is probably a yen positive in a sense. But at the moment, really, we'll do a couple of charts that show that the moves in dollar yen has really been focused on one thing specifically, and that is interest rate pricing. Okay, so the case for a weaker dollar. Now, I just want to go to this chart here that you can see on the right-hand side before I go into that, and that is that we're going into 2019. Now, I think if you can get your dollar call right for 2019. You're pretty much done on asset allocation. That to me is, I think, the US dollar is one of, if not the most important markets for 2019. And what happens if you look at the Bank of America Merrill Lynch fund manager survey, and this gets a lot of press every week. A big group of fund managers, they control a large percentage of the world's financial market assets and flows, give us an understanding about where they, what are the different things that keep them awake at night? The tailwinds for markets, the headwinds for markets. At the moment, I've cherry picked this one out because they're saying that the biggest consensus trade for 2019 is what's happening in is the long consensus US dollar trade there, and the majority of people there, are saying one, which is not part of this, is that long US dollar is the biggest consensus trade for 2019, and you can see around about 55% of people at the same time are saying that the US dollar is overvalued. So their biggest concern for 2019 is that the long US dollar is the big consensus trade for 2019. Now the problem for me with the long US dollar consensus trade is that the last time we saw this level of people saying that the US dollar was this overvalued was back in 2002. Now, if you pull up a chart of euro dollar, the last time the fund manager surveys, and okay, yeah, I get it that different people were probably surveyed at that time, but if we look at the go back to where we've circled this red, the last time it was these kind of levels. The euro dollar was trading around 90 cents. In the next 2 years, euro dollar actually traded up to 160. So by July 2008, sorry, that's 6 years, we say, that there was a progressive move up. We actually saw the highs of 160.38 coming through in euro dollar. So that point there, where this amount of people said that US dollar was overvalued, we actually saw a fairly chunky move lower in the US dollar. We also saw dollar yen at that time trading around 130. In 3 years' time, that got down to 101, and then subsequently a couple of years later, we got down to 75 cents. So this chart tells me that there is, when this amount of people are saying that the US dollar is overvalued, being long US dollars has its concerns based on the history there. So, for me, there are downside risks to the US dollar for this year, just because it's such a crowded position. Now, again, we go back to excess liquidity. We go back to balance sheets, and what I've done here is I've shown the US dollar index. Now we offer the dollar index. The code there is USDX on MT5. For people who are not who trade FX markets and don't know what the dollar index is, and that USDX, effectively it's a basket of currencies weighted against the dollar. So that we look at it on a more broad, sort of more holistic view. So to give you an example, the euro has about a 57% weighting in that basket. Obviously the euro is the second biggest traded currency out there. Then you've got some yen exposure in there. You've got some various other big G10 currencies in there. But you can see that when the US dollar's going up, other currencies are obviously falling against it. So the euro's falling against it. The yen's falling against it. Blah blah blah. So we're using the US dollar as a proxy of a sort of a more broad US dollar stance rather than just take one currency. So when you're trading the US dollar index, not many people do actually trade the US dollar index, whether it's through us or any of the other brokers. Obviously, most people stick to cable or dollar yen or euro dollar. But if you're looking at this as a broad understanding, about 57% of this is euro dollar. What we can actually see here is I've actually flipped the excess reserve. So if the balance sheet is contracting, you've seen this excess liquidity in financial markets falling effectively. So what we've got is we've actually flipped it. So when you see this situation here, is that excess liquidity is coming out of markets, because I flipped it upside down. The balance sheet is contracting, excess liquidity is coming out of the market, and we can actually see this being a US dollar positive. You can see here that excess liquidity is going up, US dollar goes down. Excess liquidity is going down, doing the opposite, and the US dollar is going up. This is when QE effectively ends. Excess liquidity continues to come out of markets, and then we see this turning point. This is the point now where we're starting to see quantitative tightening coming through. The balance sheet of the Federal Reserve is starting to pull back. Excess liquidity is coming out of the markets. The Federal Reserve are concerned that the excess liquidity in the markets at a time when we're seeing this rampant excess economy, a fiscal stimulus from Donald Trump, is going to lead to outright inflation. Controlled inflation that you can't control. Now, any central bank can control or create inflation. It's what that inflation looks like. Now, the problem with Donald Trump coming into power and hitting us with this massive fiscal stimulus is that spreads are very large on USDX. That could be the case, but no, you're right, and they correlate well with euro dollar. So yeah, absolutely. If the spreads are wide, and I'd like to believe that we're competitive relative to the brokers, then yeah, trade euro dollar. As I say, it provides a huge amount of variability. So yeah, you can use euro dollar. I could have overlapped euro dollar there. So yeah, good call there, Milova. So what you've got a situation is the textbooks when you study economics is that when you get a huge monetary stimulus, and they're trying to create inflation through changes in monetary policy by the central bank, we shouldn't see a situation where economics are starting to respond and we're seeing growth at 4.2%, but yet we see a massive fiscal stimulus. That doesn't happen, and you need to see a situation where the economy starts to tail off as the monetary stimulus comes out of the market, and then you hit people with a big fiscal stimulus. Never have we seen a situation where Keynesian economics is we don't see a fiscal stimulus working at a time when where there's so much liquidity out there, and that's what just confused so many people, and that's what's accelerated the Federal Reserve. So as we saw a situation where the balance sheet contracted, excess reserves are coming out of the market, you can see with the US dollar responded. So if you're trading the US dollar, whether it's euro dollar, Mykola, or any of the other markets, again, the idea here of what's happening with the Fed's balance sheet and the excess reserves is influencing. We can clearly see it here for me, what's happening and it's actually front running the dollar. So what happens here? So if this goes down, effectively you're seeing a situation where excess reserves are coming out of the market. And actually, we're going to see excess reserves increasing, and that's going to be a dollar negative, or a euro dollar positive, or an Aussie dollar positive. So this green line here, which I'll update on my daily fix on a regular basis, if this continues to head lower, we're going to see the dollar down. But if this continues to head higher, then I'm going to change my view, and I'm going to say, well, I think the dollar's going higher. We can actually see the same situation, the same dynamic playing through here. Now, I've got the S&P, which is the blue line. And that's actually just the normal setting. So you can see the S&P going up here. And you can see also the Fed's liquidity and the excess liquidity in markets also going up as well. So you can see that there's a decent correlation here. Again, you can make an assumption that the excess liquidity in markets is coming out here. S&P turns, sort of meanders along. Excess liquidity comes out. The balance sheet's contracting. Federal, this is what we saw from September. Again, markets are just getting a nice sort of lag. We've had a situation where the change in liquidity has changed, and the S&P's benefited from that as well. So again, if you can understand where excess liquidity is going, you can pretty much see how the S&P, which is the world's biggest equity market, and the dollar's trading. This is why I look at excess liquidity. This is why I look at fund flow above everything else. You can see here that turns in these markets will predict where these markets are going. Again, you can see, I probably won't go into that chart too much, what's going to happen with the dollar. So the dollar, again, is very much going to be going down to what's happened in what's happening in the balance sheet. But what I think as well is one of my thesis for 2019 is I think we're going to see a catch up from the rest of the world. If you look at the S&P and the outperformance you've seen there relative to other markets, be it emerging markets, China, be it Europe, be it Australia, there's been this massive outperformance from that market, be it because of better growth, liquidity, all these factors. That's going to change. This year, to me, I think the rest of the world will do better. Now, I'm actually trading this myself through long-short strategies, through pairs trades. You can do that really well through ETFs. You can do that really well through long and short different indices. But I think at the moment, if you look at this top chart here from Morgan Stanley, you can see here that the growth rate of the US is slowing down. So in Q2, we had 4.2% GDP. Again, this is when the Fed's balance sheet is still very abundant. Trump's hit us with a massive fiscal stimulus, and we're getting 4.2% growth. Fantastic growth. It shouldn't be happening that you have those two things running concurrently. And then, you've seen as some of that fiscal stimulus comes out of the market. They're looking for what, 3.6% in Q4. Now that to me seems too high. I think we're probably looking around 3% personally. But you can see that the growth rate, this is based on a year-on-year change, is going to meander down to about 1%. So based on where they see this going, if you sit in the camp that we're probably going to get a recession in the US by at some stage this year, then you're looking probably going into the end of the year. I still don't sit in that camp myself. I think there's probably about a 30% chance we see a recession probably in the next year or two, which a lot of people I know will disagree with me, and that's fine. But you can see here, based on their economics, and this is probably be a consensus trend. You're going to get different houses with 10 basis points, 20 basis points either side of that number. But you can see a situation where the trend is for slower growth in the US. Now, what does that mean? Now, okay, they're fine. I'm not sure their rationale for why we're going to see a pickup in through these years here.